Hey guys, what's up? Welcome back to Money Mondays. Today we're going to be talking about the real versus the financial economy. This concept is one of the fundamentals that should underpin your investment philosophy, especially when it's in the long term. You will see what I mean when I begin the webinar itself and as I recount the information that is on there, of course. This is one of the things that's going to allow you to see things how they truly are and flip everything that we take for granted on a day-to-day basis on its head. And like I say, this will be the linchpin to your long-term investment philosophy. What do I mean? You shall see in just a moment. So let's go ahead and talk about the real versus the financial economy. What an interesting concept. So first of all, as we know, fiat money, the four different types of money, the current one that we use in our economy, and we have used for quite some time, is fiat money, which basically means that money can be created arbitrarily. It's printed out of thin air and it's distributed to everyone who constitutes the particular country in which it was created, whichever economic system, whichever country they exist in. Effectively, the government creates the money, spends it, and gives it to the population in order that they might spend it itself, and then therefore perpetuates the economy itself. Now, as we know, it's not backed by anything. It's certainly not backed by gold as it once upon a time was. It's not even fractionally backed by gold. It's backed by absolutely thin air. And then what this means is it can be created arbitrarily, but you don't want to do too much of that, of course, because that will lead to inflation, which is what we're seeing at the minute. We're paying the price for all that money that was created during the COVID crisis. Now, interestingly, for every £100 that is created out of thin air, most of that money does not end up in the day-to-day world. Most of that money ends up reinvested into assets, and therefore we see inflation predominantly in the price of assets versus the real world economy. Now, because more of this money winds up in assets, what it means is their price increases at a rate that's greater than what we see in the shops. Therefore, we know that if we buy the right assets, whatever we invest at the time will grow at a more rapid rate than prices in the shops. Therefore, it will grow our wealth because we're beating inflation. How does this work? Think about it. Whenever there's an economic downturn, the government creates money. Now, it doesn't just stash all of this money in its own bank accounts, then it's of no benefit to society whatsoever. It doesn't just create it so that it can just stare at a pretty number on the screen. It has to release it somehow. How does it do this? What it asks the central bank to do once it's created the money is buy assets. It will buy stocks, or it will lend it to banks to buy assets. And what it means is supply and demand, the price of the asset then goes up. What that means is that everybody appears richer. The more your house is worth, the richer that you appear, the more money that you can borrow from the bank. The more money that you can borrow from the bank is the more money that you will have to buy other assets. Think about it. What do people do when they mortgage houses? They take the money, they maybe rent it out, then they do the house up a little bit, remortgage the house because it's worth more, right? Take that money and buy another house and rinse and repeat. The whole thing only works if the price of the house goes up. And that concept is what underpins the whole flipping economy. Everything has to continue to going up in price so people get richer. If things start going down in price, people have to sell their assets in order to pay their debts. Now, if that happens, that's just going to continuously create this downward cycle where people are continuously selling things in order to cover their debts until everybody's debts are completely eliminated. That takes a long time. That's what happened in the Great Depression in 1929. That's literally what happened. They didn't have fiat money back then, they had fractional money. That's why FDR had to repossess America's gold. Read it up. It's a flipping crazy story. Nowadays we don't have to think about that. Nowadays we just have to create more money. And money printing isn't always a bad thing. We can use it to fund research, to fund amazing things, to fund the things that perpetuate and advance humanity. In fact, that's one of the reasons why they reckon there's been so much growth over the last however long. But the issue is when this debt bubble gets to a point where the repayments to service the debt are so incredibly huge that nobody can afford them, and then therefore they have to sell their assets. And then at that point we have an issue because we either print more money and put inflation up, or we reduce interest rates, but they can only go so low. Anyway, we're going off on one. Long story short, The principle of this is for every pound that's created, the majority of that money ends up in the financial economy in things that are assets like houses or paper assets like stocks and bonds versus what ends up in day-to-day circulation. That's why the rate of inflation is 3%, yet the stock market appreciates by 10% on average every single year. That's the average figures. The difference between those two numbers, 7%. That's what we can expect. That's our margin. The lower inflation is and the higher the market appreciates, the more money we make. That's the philosophy behind long-term investing. And this is why it happens. This is one of the fundamental principles that underpins it. So just be aware of that. And as long as there's more money printing, which there always will be, assets will continue to go up in price at a disproportionate rate to prices in the shops. Now, I get it at the minute. I know what people are going to throw back at me. But James, inflation is 10% at the minute. That's crazy. And assets are recovering as of the last few weeks, but they're certainly not appreciating at that rate. And what I would say is, listen, you're looking at the micro. We need to look at the macro. These are the overall trends. Inflation is on average 3%. The stock market appreciates at 10% on average every year. Volatility is a factor. That doesn't mean that you can put in your money this year and get 10% more next year. Who knows what's going to happen in the short term? I'm talking about the very long term, so we've got to be careful. No financial advice. Summary. This is one of the reasons assets outpace inflation. Inflation is literally a linchpin to economies and fiat money. It's a given. As long as we have fiat money, we're going to have inflation. Therefore, this effect will continue. Therefore, the theory would be that assets appreciate in price. Certainly, the only given in investing is that your money will depreciate in value as time goes on. Surely there must be a better place to store wealth. That is the question that you should ask yourself right there. And that's the point behind investing long term. This is the thesis behind long-term investing, as we just said. See you next week. Thanks so much.